I think lending is a very age-old product, right? So banks, when you think about a bank, the first question that you will ask a bank is, I want to lend money to me, or will you lend money to me, right? That's what banks stand for. Either you deposit money or lend money. So lending is synonymous with banks. But startup lending, if you see, at least from India context, obviously venture debt is a very age-old concept in the US. Probably they're like a 30, 40-year-old concept in the US. But in India, venture debt is fairly new as a concept to startups. And even new is bank lending to startups. You ask me if there are any signals that beyond financial statements. Obviously, financial statements become the first and foremost way of financing. But some of the things that I think as a bank we look at is obviously first and foremost is the team and the founder. Okay, what's the kind of pedigree of the founders, the management team, what kind of background experience do they have? What kind of credibility they bring with them as they join startup. Like a lot of these growth stage and late stage startups bring a lot of professionals from corporates, right? So you look at the credibility of the team and the founders primarily. The other would be transparency. So when you ask for data, information, how transparent, and these are all private companies, right? They're not listed, so they're not under obligation to provide data publicly. But how transparent and how forthcoming are they on information sharing becomes very, very important. And lastly, I would say investor sentiment. So one good advantage of the startup ecosystem is that it's a very close-knit community, right? So investors know each other, founders know each other. And actually you should take feedback on a particular company from an investor who's not invested there, to see whether, what does he think about that segment, that founder. Did they ever see that company? Did they ever look at it? When the startup becomes my client, we start with analyzing what can we do to ease their operational flow, right? Whether it is a B2B company or B2C, enterprise businesses. So how do I help them in transaction banking, helping them with payables, receivables, giving them automated solutions? So that starts with that. How do I help them in global outreach? We are a global bank. So can I help them set up shop in other countries? Give them a single platform. Like SaaS is a very good example where you have made in India but selling in other countries. So how do I give the founder or the CFO access to all the accounts that he has in a single platform, make life easier for them? And at different stages of a startup, they need different products, right? Even, for example, even investment banking is a product for us. So how do I help my startups in say either a private or a public market journey, right? So I'll get my investment banking team involved. We have a debt capital markets team, which helps in debt raises like bonds and other, access private credit also. So at every stage we have different products, and lending is just one part of the whole journey. I think, yes, they do expect faster decision making for sure. But the only challenge is some of the data points are not like plain and simple, right? As compared to established traditional business where you have 10 years of profitable balance sheet and you just have to look at certain numbers and make decisions. What we have done is we have created separate teams to look at lending proposals because they require a little more expertise. So it speeds up. So as you have people who are more experienced and focused, it speeds up things. So we have designated relationship teams which drive credit for smaller companies. And as the smaller companies, I'm typically referring to the early stage Series A, Series B. So there's a separate team because the ticket sizes might be smaller. The way they analyze a smaller startup is a little different. But as they become bigger, like Series C in late stage, we transition into a larger kind of relationship team, which is much more experienced RMs who are adept in looking at higher ticket sizes, bigger volumes of data, etc. So the whole idea is to create specializations in within the verticals also and within RMs so that they are able to speed up things and and create an ecosystem where you can have information sharing much faster. Then they're supported by analysts, underwriting RMs, etc. So we have created the ecosystem to do it. As of now, data also plays some amount of role. Like we use a lot of data sources that is available. We've created internal data sources also to find out, to help the underwriting process much faster. Within the risk team also, we have created specializations for risk approvers who understand startup proposals much better. Like it's very unfair to expect somebody who looks at a traditional company in the morning, which is profitable and meets all the debt ratios, and then suddenly in the afternoon you expect the person to look at a completely opposite, EBITDA negative, high cash burn. So that takes more time for that person to. So we have created that specializations with certain people so that they keep looking at these kind of proposals, and that increases their knowledge also, right? So they are able to better spot anomalies when you keep looking at the same kind of proposal. So that speeds up, and for us also from a credit risk perspective also, it is better if you create that specialization. I think if you have, say, teams who specialize, you also create that connection within the ecosystem. So if I have a portfolio of say 20 startups, okay, now invariably my 20 founders will be connected to the ecosystem, right? So for me to prospect new clients becomes easier. To get feedback on certain founders or certain proposals or startup companies becomes much more easier. So that also creates better underwriting and faster underwriting. What we aim to do, and majority, I think 99% of the time we try and achieve it, is structuring facilities which are fit for purpose, fit for the end use, self-liquidating kind of transactional lines. So instead of giving a plain vanilla overdraft, which essentially is the most riskiest product that a lender could give, to giving the company structured trade products either for buying or selling, discounting lines, bill discounting, invoice discounting lines, import financing lines or export financing lines. So the whole idea is to give them facilities which are self-liquidating. So if the working capital cycle is say 60 days, why give them a overdraft which is like evergreen, like 12 months available? You'd rather give them a facility which is, and you can offer it cheaper also. Like there is a risk-weighted asset for every product. So if you're giving an overdraft, you will have to price it higher because you're taking higher risk. But if you're able to give a bill discounting line or a structured trade facility or a domestic purchase line, you can actually price it lower and make it self-liquidating. So you buy something, you manufacture, you sell, the whole limit also gets liquidated along with the whole cycle, right? So that's what we try and do, so that we're not out of fund at any point in time in terms of, okay, the companies actually use a working capital fund for something else, right? So we try and say, okay, this is the end use that we're giving. We are ensuring that you're using the facilities for that particular end use. Banks have also understood the whole power of ecosystem and being part of the ecosystem, right? So beyond just the banking part of it, we actually do a lot of work within the ecosystem. Banks also enable a lot of fintech. So for example, there are a lot of banks who do sandbox environments set up for their fintech startups. We do a lot of work on, in helping in supporting, or rather giving inputs to fintech companies on product development. It could be cross-border trade, it could be domestic payment processing, etc. So we can actually give inputs to them on, okay, what do I as a bank, what do I expect, what works for me. We are very keen on looking at digital lending, right? Lending basis, just database lending. So that's my use case. So how can a fintech really help and come and help on that? So I think the global connectivity, as I said, one of the things that we do is global connectivity. So beyond just lending and banking, there are a lot of things, avenues that banks actually do nowadays within the ecosystem. We track performance on a monthly basis. We look at performance in terms of, say, sales, margins, CM1, CM2, burn, etc. on a monthly basis. Where do you draw a line? Obviously, we have internal parameters on, say, okay, if say, for example, the company doesn't have a certain amount of runway beyond a certain level, then we will try and put it in a special purpose kind of a thing. Okay, this is an account that I have to monitor more closely for the next quarter, 2 quarter. Okay, so that we can find out early signals much more. So we draw a line in saying, okay, your runway is lower than this, you're not raising money, your burn has gone up, for example, or your sales has come down. Because some of the consumer tech names, you have a situation where you burn a lot of money, advertise, give discounts, you sell suddenly, but the moment you stop it, the sales come down. So then that actually shows that there is no product market fit, or your product is not really synced up with the consumer. So you can't keep on burning money, right? So when you see certain metrics where your trajectory of burn is high, your sales is not keeping up to the burn number, or your percentage, your CM contribution margin as a percentage of your sale is actually going down or stagnant. So these are some of the signals that we look at, but yeah, indicators for us. But yeah, when you drawing a line, I think it's gradual process. But yeah, if there's no runway and there's no debt serviceability and equity is drying up, then yeah, that becomes a bigger concern.